Hey everybody, Stewart Heath here, CEO of Harvard Greats Corporation. In our planning and forecasting segment this week, I'm continuing in my series of metrics that every business must be monitoring. Today I want to talk about profit margin, and you may be thinking, well, you just talked about gross profit, and yeah, I did. But there's other profit margins to be concerned of. Actually there's three you want to monitor. We've talked about gross profit, and that's really the margin where you determine whether or not you're making money on selling your product or service. There's operating profit margin, and then there's net profit, which is after everything, but operating profit margin will come with a lot of different names. It's also a very important measure because that's after you take on overhead. What's overhead? Well, that's what it costs you to be in business. You think of these as fixed costs. You might have office rent, office payroll, other things, telephones and the like. So that's, you take gross profit, then you deduct your overhead, and that gives you an operating profit. Other names for operating profit will be earnings before tax, or EBIT. In the financial world, like in the stock market, if you're researching the stock, you'll see something called EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Another quick way to say that is operating cash flow. How much cash was generated by the business before you did things like pay interest on loans and taxes and other non-cash expenses called like depreciation and amortization. So operating profit is closely related to EBITDA. It's a very important measure that a lot of investors or bankers might be interested in. Then there's net profit. So after operating profit, you're going to deduct other things that are business expenses but aren't necessarily as related to everyday operating of the business. Like I just said, there's interest, there's income tax expense, depending on what type of entity you are. If you're a LLC or a S corporation, you may not have income tax expense. But almost every business has some other expenses that would go sort of below EBITDA. And after everything, then you get net profit, or in the accounting world, it's called net income. You actually need to monitor all three of these: gross profit, operating profit, and not net income. It is challenging to get an SBA loan if you don't have positive net income. You might have cash flow for days, but you need to show a net profit in order to qualify for some financings. So all of this is part and parcel to financial analysis, which needs to be done as a part of planning and forecasting, and that's what we do. So if we can help you with that, let us know. Otherwise, I hope you enjoyed this. Thanks.